Hello, we are the Alpha Consulting Group, and today we present our financial analysis of Shoprite Holdings Ltd. Just a quick disclaimer, this analysis is for academic purposes as part of Group 12's project for the Financial Statement Analysis course BBA 9215, taught by Dr. Byron Kalulu at the University of Zambia. The content here is not actual financial advice. The purpose of the assignment was to analyze a company listed on the Lusaka Securities Exchange for a retired investor considering investing 1.5 million kwacha. Our task was to determine the investment viability of our assigned company, Shoprite Holdings, based on 3 years of financial statements, while also considering the implications of its accounting standards. Our presentation will be structured in 10 key sections. We'll begin with an introduction to the company, then proceed to a detailed profitability analysis, followed by liquidity and solvency. We will then analyze the efficiency of the company's activities, its common size analysis of the income statement and the balance sheet, the cash flow, and then we'll then go on to assess the earnings quality and compare the IFRS to the US GAAP and conclude with our investment decision. This analysis was conducted by our team at Alpha Consulting Group, and our team consists of the following: Muka Chindovole, our team leader and market analyst; I, Mbile Ndulinga, the presenter and financial modeler; Niza Nankamba, the financial data analyst; Gabriel Moyo, the researcher; and finally Mwenzi Lwando, our accounting standards specialist. We utilize the following: Microsoft Excel for charts and graphs, PowerPoint, Microsoft PowerPoint for this presentation, Canva for video production, and corporate audio by Pine Records. Part 2. Company overview of Shoprite Holdings Ltd. Shoprite Holdings Ltd is Africa's largest supermarket group, founded in 1979 and headquartered in Cape Town, South Africa. It operates in the retail and consumer goods industry, providing grocery, furniture, pharmaceutical, and financial services across the continent. Shoprite runs over 2,900 outlets across Africa. Its strongest footprint is in South Africa, operating under brands like Shoprite, Usave, and Checkers internationally. It has a presence in several Southern African countries, including Zambia. Its operations are diverse, encompassing food retail, liquor stores, made-right pharmacies, house and home furniture stores, compute ticket services, and the Checkers 6060 digital grocery delivery platform. Shoprite is publicly listed on the Johannesburg Stock Exchange, or JSE, the Namibian Stock Exchange, the Lusaka Stock Exchange, and the A2X. Its shareholding is dominated by large institutional investors like the Public Investment Corporation and Alan Gray, with ongoing strategic influence from the YS family. Shoprite maintains the leading position in Africa's food retail, leveraging its scale, supply chain, and discount formats. In the financial year 2024, merchandise sales rose by 12% to 240.7 billion rand, showing strong growth. And then critically, for our analysis, Shoprite prepares its financial statements in full compliance with International Financial Reporting Standards, or IFRS. It does not use US GAAP, and its statements are audited by Ernst & Young. The return on equity measures the amount of net income returned as a percentage of shareholders' equity. It is a primary gauge of a company's profitability and efficiency at generating profits for every unit of shareholders' equity. The formula is broken down into three components: the profit margin, which is net income over revenue; the asset turnover, which is revenue over average total assets; and the equity multiplier, which is the average total assets times the average total equity. Shoprite's rate of return on equity has been consistently excellent, at 23.6% in 2021, 24.3% in 2022, and 22.7% in 2023. This indicates a strong value creation for shareholders. The DuPont analysis reveals that this high volume is driven not by extreme high profit margins, but by exceptional asset efficiency and the strategic use of financial leverage. The net profit margin reveals what percentage of revenue is translated into actual profit. It is a key indicator of overall profitability after all expenses, interest, and taxes have been deducted from revenue. The formula is net income over revenue times 100%. Shoprite's margins are thin, as in typical high volume, low margin retail. We see a margin of 2.84% in 2021, an improvement to 3.10% in 2022, likely due to post-pandemic recovery and stringent cost control, followed by a compensation to 2.7% in 2023, reflecting intensive competitive and inflationary pressures in its operating markets. The gross profit margin indicates the financial health and pricing strategy by showing the proportion of money left from revenues after accounting for cost of goods sold. The formula is the gross profit over revenue times 100%. Shoprite's margins are stable, but tighten slightly, moving from 24.1% in 2021 to 24.5% in 2022, then down to 23.6% in 2023. The dip suggests that the company may have absorbed some input cost increases to maintain its lowest prices, competitive positioning, protecting sales volume at the expense of margin. And the last margin is our operating profit. The operating profit margin measures the proportion of revenue left over after paying for variable costs of production like wages and raw materials before interest and taxes. It is a clear indicator of the efficiency of a company's core business operations. The formula is operating income over revenue. Shoprite's margin is remarkably stable. It was at 5.65% in 2021, 5.8% in 2022, and 5.6% in 2023. This demonstrates strong operational control and the ability to manage selling and administrative expenses effectively despite external challenges, confirming the leanness of its operational model. Part 4. We now turn to liquidity and solvency. Liquidity ratios measure the company's ability to meet its short-term obligations, while solvency ratios assess its long-term financial health and capacity to meet long-term debt and other obligations. The current ratio measures the company's ability to pay short-term obligations or those due within 1 year. It indicates whether a company has enough resources to cover its short-term debts. Shoprite's ratio has improved from 1.13 in 2021 to 1.28 in 2023. While the trend is positive, a ratio above 1.5 is generally considered comfortable. However, a ratio around 1.2 suggests that the company has just enough current assets to cover its current liabilities. indicating adequate but tight liquidity and minimum idle resources. The quick ratio, or the acid test ratio, is a more straightened measure of liquidity. It excludes inventory and other less liquid current assets, as inventory may not be easily convertible to cash in the short term. Shoprite's quick ratio is low, improving slightly only from 0.44 to 0.50 over the 3 years. A ratio significantly below 1.0 indicates that the company cannot fully pay its current obligations without selling inventory. This highlights a significant and critical reliance on the rapid turnover of stock to generate the cash needed for meeting liabilities. The cash ratio is the most conservative liquidity ratio. It measures a company's ability to pay off its short-term liabilities with only cash and cash equivalents. This shows the immediate liquidity available, and Shoprite's cash ratio is very low, between 0.30 and 0.35. This confirms that the company operates with minimal cash buffers, relying almost entirely on the continuous and uninterrupted cash inflow from daily sales to fund its operations and meet its short-term commitments. This is a highly efficient but potentially risky model. The debt-to-equity ratio is a solvency ratio that compares a company's total liabilities to its shareholder equity. It shows the proportion of corporate financing that comes from creditors versus that one that comes from shareholders. Shoprite is highly leveraged, with ratios of 1.56 in 2021, 1.45 in 2022, and 1.60 in 23. This means that for every kwacha of equity, there is about 1.5 to 1.6 in debt. This leverage magnifies returns for shareholders when times are good, as we saw in high return on equity, but it also significantly increases the financial risk, especially in a rising interest rate environment, as interest expenses can consume a large portion of profits. The interest coverage ratio measures a company's ability to handle its outstanding debt by comparing its earnings before interest and taxes to its interest expense. It shows how easily a company can pay interest on its outstanding debt. Shoprite's coverage is adequate but strong, ranging from 3.12 to 3.60 times. This means that its operating profit is about 3 times its interest obligation. This provides a buffer, but it leaves limited room for error in earnings. If earnings were to decline, or if interest rates on its substantial variable debt were to rise, which could quickly pressure profitability. Part 5. Efficiency and activity ratios. Next, we analyze efficiency and activity ratios, which measure how effectively Shoprite utilizes its assets and liabilities to generate sales and cash. They are also known as asset management ratios. The asset turnover ratio measures a company's ability to generate sales from its assets by comparing revenue to average total sales. It indicates how effective management is at using assets to generate revenue. Shoprite's ratio is outstanding and improving from 2.14% in 2021 to 2.27 in 2023. This means that the company generates over 2.2 rands in sales for every 1 rand invested in assets. This world-class efficiency is a core strength and a primary driver of its high return on equity, showing superb management of its assets base. The inventory turnover ratio measures how many times a company's inventory is sold and replaced over a period. A high ratio implies strong sales and effective inventory management. Shoprite's ratio is high and stable, around 6.9 times per year. This indicates that extremely efficient inventory management. Stock moves from shelves very quickly, which reduces holding costs, minimizes spoilage risk, and ensures that product freshness. The rapid turnover is an essential to support its low liquidity ratios. Receivables turnover and days outstanding. The receivables turnover ratio measures how efficiently a company collects revenue from its customers. It calculates how many times average receivables are collected during a period. This is directly related to days of sales, which is the average number of days it takes to collect payment after a sale has been made. Shoprite's receivables turnover is exceptionally high at over 41 times, indicating the vast majority of sales are cash-based or collected immediately. This is reflected in an incredibly low DSO of under 9 days. This is a massive strength, ensuring a rapid conversion of sales into cash, and is the fundamental engine that supports its low cash and high inventory business model. Part 6. Common size analysis. A common size analysis standardizes financial statements by expressing each line item as a percentage of a key figure, such as revenue for the income statement or total assets for the balance sheet. This allows for easy trend analysis and comparison across time with other companies. Over the past 3 years, the common size income statement shows remarkable stability. The cost of sales consume about 75 to 76% of revenue. The operating expenses take up about 18 to 19%, leaving a stable operating profit of around 5.7%. The net profit margin, as we saw, fluctuates between 2.7% and 3.1%. This consistency confirms a mature, well-controlled, and predictable business model. On the other side, we see a rough 55 to 45% split on non-current assets and current assets. A significant portion of non-current assets consists of right-use assets from leases. Current assets are dominated by inventory, and on the liabilities and equity side, the structure is heavily weighted towards liabilities, which make up about 72 to 74% of the financing. This is driven by lease liabilities, borrowings, and trade payables. Equity represents only about 26 to 28% of total assets, visually reinforcing the high leverage we identified earlier. Part 7. Cash flow analysis. The statement of cash flows tells us whether the profits on the income statement are being converted into actual cash, which is the lifeline of any business. So we have some key trends for Shoprite. Shoprite's operating cash flow is strong and consistently positive, which is the core funding source for the business. Investing cash flow is consistently negative due to significant capital expenditures on new stores, refurbishments, and logistics infrastructure. Financing cash flows is also negative, reflecting net payments or net repayments of debt and lease liabilities, as well as dividend payments to shareholders. Then we have the common size cash flow, which are key line items expressed as a percentage of revenue. So when expressed as a percentage of revenue, we see that operating cash flow represents a healthy 3 to 4% of revenue. CapEx investments consume about 2.3% of revenue, which is substantial but necessary for maintaining and growing its store network and competitive edge. Then as for cash flow quality and sustainability, most importantly, the quality of earnings is high. Operating cash flow consistently exceeds net income, with a ratio of 1.64 in 2021, 1.17 in 2022, and 1.67 in 2023. This means that the reported profits are backed by real cash inflows from operations, making them sustainable and high quality. However, the dip in 2022 was related to one-off working capital movements, and it is not a structural issue. Part 8. Earnings quality and red flags. Our analysis now turns to assessing the quality of Shoprite's reported earnings and identifying any potential red flags that might concern an investor. So we'll first look at the earnings quality. Earnings quality refers to the proportion of income that is backed by actual cash from operations, not just accounting entries. High quality earnings are sustainable and repeatable. Shoprite's earnings quality appears strong. The profits are very well supported by actual cash generation, as we saw. Operating cash flow consistently exceeds net income. And furthermore, if we adjust for one-off items, profit from continuing operations shows a healthy growing trend, rising from 4.7 billion rand in 2021 to 5.7 billion rand in 2022, and further to 6.3 billion rand in 2023. This highlights a solid upward trajectory from the company's core ongoing operations. And as for red flags, a red flag is a warning signal that indicates potential problems with a company's financial health or reporting practice. So despite strong underlying earnings, Shoprite's reported results are regularly influenced by significant one-off and non-recurring adjustments. In 2021, these included gains from discontinued operations, lease modifications, and capital losses. And in 2022, there were large foreign exchange losses and lease gains. 2023, however, saw further lease modifications. One particular anomaly was in 2022 when the OCF NI ratio dipped to 1.17. This coincided with those heavy foreign exchange losses, raising legitimate questions about the company's foreign currency exposure and the volatility it can inject into its earnings. The summary, however, is that Shoprite's core earnings remain robust and are well supported by strong cash flow, which reflects excellent business fundamentals. However, analysts and investors must look beyond the headline net income figure, because earnings are consistently affected by these non-recurring gains and losses. Therefore, adjusting for these one-offs is absolutely essential in order to gain a true and clear picture of Shoprite's underlying operational performance and to avoid being misled by accounting noise. Part 9. IFRS versus US GAAP. So a crucial part of our analysis was to consider the accounting framework as Shoprite uses IFRS. We compared key differences with US GAAP that could impact cross-border comparisons with American retailers. So first up we have leases. Under IFRS, Shoprite must capitalize all major leases on the balance sheet as right-of-use assets and lease liabilities using a single model. The US GAAP, however, uses a dual model, which may keep some operating leases off balance sheet. This means that Shoprite's balance sheet shows higher assets and liabilities than a comparable US peer. And then the next part we have impairments. IFRS has stricter impairment rules, means that losses are recognized earlier based on expected future losses that are generally less reversible. US GAAP is generally more lenient, requiring a higher threshold for impairment. Therefore, Shoprite might report either larger write-downs on assets during downturns, and this makes its financials look more conservative, but can also make its profitability appear weaker when compared to US GAAP reporters in the same situation. In the case of inventory, a major difference is that the IFRS prohibits the use of last in first out method. Shoprite must use first in first out or weighted average cost. The US GAAP, however, permits LIFO. In a period of rising inflation, a US company using LIFO would report a higher cost of goods because it sells the most recently acquired expensive inventory first and lower profits. Shoprite, however, using FIFO would show a lower cost of goods sold and higher profits and inventory values. This means that Shoprite's margins may appear artificially stronger than a US peer. However, even in their underlying performance, this is critical. And the last part is the research and development. Under IFRS, some development costs can be capitalized as intangible assets if certain strict criteria are met. However, under US GAAP, virtually all research and development costs must be expensed immediately. This could allow Shoprite to report higher profits and higher assets in the short term compared to a US company that must expense all their similar development costs immediately, affecting cross-company comparisons. Part 10, the investment decision. So we'll now synthesize all our analysis to arrive at the final investment recommendation for our retired client with their 1.5 million kwacha. The bullish argument for Shoprite is compelling. The company demonstrates operational excellence and efficiency. Its asset turnover is world-class and improving, and it has an extremely short operating cycle with days sales outstanding below 9 days. This efficiency makes the business function like a well-oiled machine. Why? Because cash generation is a standout strength, profitability is robust, and furthermore, Shoprite's position as a leading retailer of essential goods gives it a defensive business model, making it more resilient across different economic cycles. However, on the bear case, when we examine risks and concerns, we realize that the bear case highlights significant risks that cannot be ignored, especially for a retiree. The company's debt to equity ratio is high, between 1.45 and 1.60. This heavy reliance on debt and lease financing makes it highly vulnerable to rising interest rates or economic downturns. Liquidity is a major concern, with a quick ratio around 0.50 and a cash ratio near 0.33. Shoprite is completely dependent on steady, rapid inventory turnover to meet its short-term obligations. Any disruption in sales could quickly create a liquidity crunch, and profit margins are razor thin. For an investor focused on capital preservation and steady growth in retirement, these risks are very, very pronounced. And as such, we give a final verdict that Shoprite is ultimately a high risk and high reward investment. For an investor who is actively engaged and can continuously monitor the company's leverage and liquidity situation, the growth prospects may justify holding a position. However, for a retirement portfolio valued at 1.5 million kwacha, where the primary objectives are capital preservation and steady, reliable growth, the risks are too pronounced. Shoprite's aggressive financial structure and low margins make it unsuitable for a conservative long-term retirement portfolio. So our recommendation is to hold any existing shares if the investor already has them, but avoid committing new retirement capital. Instead, we advise that the funds be directed towards less leveraged companies or diversified investment vehicles with a lower risk profile and a greater focus on stability. Thank you very much.